Today, we're diving into Hims and Her stock, a telehealth powerhouse that's reshaping healthcare. Is this stock a long-term winner or overhyped? We'll explore the financials, tackle the risk, and project its future with a balanced lens. So Hims and Hers is a telehealth platform connecting consumers to licensed healthcare professionals for personalized care in men's and women's wellness, sexual health, dermatology, and hair care, and also lately mental health. Launched in 2017 based from San Francisco, Hims has scaled its subscriber base to 2.2 million by Q4 of 2024, which represented a 45% jump year over year. Their direct-to-consumer model delivers affordable, tailored prescription and non-prescription products, driving in $1.5 billion in revenue in 2024, representing 69% up from 2023. But rapid growth also invites scrutiny, especially with their hefty marketing spend. Let's break down the numbers and see what's fueling this rise. Starting with financials, Hims and Hers posted $1.5 billion in revenue in 2024. The net income reached $126 million, flipping out $23.5 million loss from 2023. Q4 of 2024, earnings per share hit $0.11, topping analyst estimates. Adjusted EBITDA came in $277 million, signaling stronger operational efficiency. Excluding their weight loss segment, which we'll cover soon, revenue still grew 43% to $1.2 billion, underscoring the strength of their core offerings in dermatology, mental health, and sexual health. For Q1 of 2025, management guided of revenue between $520 to $540 million. For the full year of 2025, the guidance is around $2.3 to $2.4 billion, projecting a healthy 55 to 65% growth. Let's talk about the critical piece of their financials: selling, general, and administrative expenses, particularly their marketing budget. So in 2024, SG&A expenses totaled $870 million, with roughly 60%, about $522 million, tied to marketing. That's a massive 35% of revenue. Why so high? Hims is aggressively building brand awareness and acquiring customers in a competitive space. They've leaned heavily into digital ads, influencer partnerships, and podcast sponsorships to become a household name. But here's the kicker: as Hims cements its position as the go-to health platform, think Netflix for streaming or Uber for rideshares, the spending is expected to taper a little bit. With 2.2 million subscribers, growing brand recognition, customer acquisition costs should decline over time. Management has signaled marketing as percentage of revenue could drop to 25 to 28% by 2027, potentially freeing up cash for investment or margin expansion. For context, Netflix marketing spend is now roughly around 10% of their revenue, because everyone knows their brand. Hims could potentially be on a similar path, which could be a game changer for profitability. This table tracks Hims and Hers gross margin. In 2022 and 2023, margin rose as the company scaled. In 2024, we saw a slight dip to 79.5%, reflected mostly higher cost from their weight loss offering, particularly GLP-1 drug. Management projects a rebound to 80% in 2025 as they optimize supply chain and shift to oral and liraglutide-based weight loss solutions. High gross margin shows that Hims can sustain profitability while growing. Pair that with decline in marketing cost as brand loyalty grows, you could get a recipe for stronger cash flows. But let's actually address the weight loss controversy shaking investor confidence. Hims and Hers grabbed attention in 2024 with its compounded GLP-1 drug, like semaglutide, the active ingredients in Ozempic and Wegovy. Priced at under $200 a month compared to $1,000 for branded drugs, this offering accounted for 15% of 2024 revenue at around $225 million. But in February of 2025, the FDA ruled that semaglutide was no longer in shortage, barring compounders like Hims for selling it. The stock plummeted roughly 25% in a single day as investors feared growth slowdown. Although I do believe that the market overreacted, and here's why. First, Hims actually saw this coming and was pivoting to overall weight loss drugs like liraglutide injections, forecasting 700 or so million in weight loss revenue for this year, over 3 times of 2024's GLP-1 contribution. Secondly, their core business is rock solid. Dermatology revenue soared 55% for men and 100% for women in 24. Mental health and sexual health grew 40 and 35% respectively. Now you might wonder then, what is the risk? Well, transitioning customers to the new weight loss product could cause short-term hiccups if uptake lags. Plus, giants like Eli Lilly and Novo Nordisk dominate the weight loss market, and competition is for sure heating up. Still, Hims' low prices and strong brand gives them a unique edge. Importantly, their marketing muscle has built a loyal customer base that trusts Hims beyond weight loss. As brand recognition grows, they won't need to spend as heavily to attract users. Much like now Netflix no longer advertises as aggressively because it's synonymous with streaming, Hims will be synonymous with telehealth. Going to the future outlook, we can see that projecting forward, analysts estimate 2025 earnings per share at around $0.65, up 20% from 0.53 in 2024. By 2027, EPS could reach just below $1 in the conservative scenario, most likely reaching much higher than that if they manage to continue increase the subscriber base. But assuming a 19 to 20 annual growth rate, this is still very healthy if we go from the increase from $0.65 in 2025 to, let's say, 0.95 in 2027. Revenue is also expected to grow 20% annually, potentially hitting $3.5 billion by 2027, although I would say that this number is probably a little bit conservative from the analyst. As mentioned before, subscriber growth drives this engine. With 2.2 million subscribers today, Hims targets 3 million subscribers by end of next year, and the same as the other numbers we mentioned before, probably much earlier than that. The recent acquisition of US-based peptide facility signals vertical integration, which could cut costs and lift margins. They're also launching at-home blood testing to expand their diagnostics, further embedding themselves in customers' healthcare routines. The marketing budget is a key variable. If Hims reduces its marketing to 25% of revenue by 2027, as projected, SG&A could drop by $200 million annually, boosting adjusted EBITDA margins from 11.8% in 2024 to somewhere between 15 and 17% in a couple of years. This is significant for a company that's already cash flow positive. Still, risk persists. Regulatory shifts could disrupt their model again, and a weaker economy might curb spending on elective healthcare. Valuation is also a consideration. Hims trades quite richly right now if you look at purely price to earnings ratios. But still, we know that the company is also growing extremely fast, so I wouldn't look at the PE ratio at this current rate, especially knowing that they have huge opportunities to reduce their marketing cost as their name recognition grows. The average price target from the analysts are around 38 and 39%, representing roughly 30% upside from current price of 28 or so. So my closing thoughts here regarding to Hims and Hers, I believe this is a juggernaut in the making with a diversified portfolio and clear path to profitability. Their hefty marketing budget of over $500 million in 2024 has built a brand that's becoming synonymous with telehealth, much like Netflix is with streaming. As name recognition grows, that spend could shrink, unlocking higher margins. Sure, Ozempic setback is a hurdle, but their pivot and core business strength suggests it's overblown in my opinion. Still keep an eye on regulatory risk, subscriber trends, and marketing efficiency. It's a strong pick for growth investors willing to ride some volatility. As always, do your homework and align with your risk tolerance. Thank you for watching. If this video added value, please smash that like button, subscribe, and drop your thoughts in the comment. Until next time, stay sharp and invest wisely.